The fundamental disconnect is what you have potentially between the bond market and the equity market. I mean, if you have Treasury yields around 2%, a bit above, a bit below, some people interpret that as a signal of a more significant slowdown in U.S. economic growth, which then is seemingly incompatible with the S&P above 3,000. So I think that's the fundamental question we have to ask ourselves. Our view is that low Treasury yields is more a reflection of the new policy of the Fed to be cutting rates as opposed to hiking them. So we don't see it as a recession signal. But I think there is a question of which of those views is actually right, and hopefully we'll get a bit of clarification on that as earnings season starts to come in.
And you mentioned bond yields right now, 10-year, of course, above 2%, sitting right about 2.136 or so. Is that a sign you think that the dollar may continue to strengthen from here? And what does that mean, of course, for some of these international companies we're getting ready to hear from?
Well, I think there's two things you have to think about. Of course, we've had trade as an issue for quite a while, and so any of the exporters are at risk from that. And at the same time, if you do get a resumption of dollar strength versus EM currencies, of course, dollar still has been reasonably strong against the euro. That's also going to be a drag on exporters. So that's something that we need to keep in the back of our minds. We do have strong domestic demand within the U.S. So that should help small caps and domestic-oriented companies. But external sales are not only important for a lot of U.S. companies, that's where a lot of the growth is coming from. So if that drags, you've got to wonder what the impact that's going to have on earnings per share.
And it was so interesting, of course, when we first started hearing policymakers talk about the idea of different tariffs. Many companies didn't exactly know what to do with that. Some were afraid to touch the issue at all. But now it seems like more and more corporate executives are sort of blaming everything on that. They're saying, look, we can't plan for business investment if we don't know what's going to happen with the cost of doing business because of these tariffs. Is that sort of something prudent for companies to do, to be honest about the uncertainty? Or does it give them some wiggle room to put up some results that are less than stellar?
Yeah, well, it's probably a bit of both. You guys, you always look for the most convenient excuse if your earnings are going to disappoint, and tariff seems to be the excuse of the day. But nonetheless, I think it is a valid consideration, not only as we try to understand what the tariffs with China are likely to do for input change and for sales for U.S. companies. You know, we still have the kind of ever-evolving threat of potential tariffs against Europe. Could it be France? Could it be Germany? Something around Russia. So it's kind of a never-changing palette of potential threats, which is, as you point out, makes it quite difficult for CEOs to plan for investment and plan for marketing campaigns.
The Fed seems to be suggesting here, at least what we've heard from Jay Powell the last several days on Capitol Hill, that we are going to get this interest rate cut. 25 basis points seems to be the biggest expectation, though, of course, we've reopened that window for 50. Is the Fed providing a security blanket to the market? And is that something that almost gives us a little bit too much security?
Well, I think the issue is what's going to be the justification for the cut. I agree it's more likely than not that we do get 25 basis points now, given that growth, or at least in the payrolls figure, was a bit better, inflation was a bit higher, so we don't seem to need a 50 basis point cut the way we thought a few weeks ago. But if the Fed continues to focus on the risk to growth as the justification for the cut, really that's not something that should be positive for equities. And there's a concern that eventually equity markets wake up and say the Fed is cutting rates because they're worried about rising risk of recession, or at least a bigger slowdown in growth, and that's going to be important. If, on the other hand, the Fed changes its tone and focuses more on low inflation as a justification for cutting rates, well, that's actually quite benign. So I think either way we do get the 25 basis point cut. The implications for the market, though, are going to depend much more on the language around the cut.